Brothers and sisters, welcome back to the channel. Today we are talking about something that destroys more trading accounts than bad strategies, market volatility, or unexpected news events. It's something that looks small on the surface, but slowly becomes a silent killer inside a trader's mind. I'm talking about overconfidence, that moment when you believe you're absolutely right, even when the market is clearly saying otherwise. Let's begin with a simple truth. The market doesn't care who you are. It doesn't care about your background, your past profits, your predictions, or your confidence level. The market rewards discipline, not ego. The moment confidence crosses the line and turns into overconfidence, the downfall begins. Every trader experiences a winning streak at some point. Maybe you entered a trade at the perfect level. Maybe the chart played out exactly as you expected. Or maybe you just got lucky. And immediately your mind whispers, "See, you figured it out. You understand the market. You can do this again." That's where the trap begins. Overconfidence creates a false sense of control, a belief that you can predict everything. And once traders start believing that, the first thing they stop respecting is risk. Suddenly, stop loss feels unnecessary. Position sizes increase, logic fades, and emotions take over. Then a single move against them becomes enough to erase the gains of 5 or even 10 winning trades. This happens again and again, yet many traders fail to realize that the problem is not the strategy or the market, it's their own inflated belief. Overconfidence also causes traders to ignore warning signs. Imagine you're long in a trade and the chart is clearly forming lower highs, lower lows, and showing strong selling pressure. But because you made profit in your last few trades, your mind says, "Don't worry, the market will reverse. You're right." And what happens? You hold the trade longer than necessary. The loss grows bigger, and reality hits too late. Overconfidence blinds you. Another dangerous outcome is revenge trading. When overconfident traders face a loss, they don't accept it. Instead, they jump into another trade quickly without analysis or patience. Their goal shifts from making profit to proving themselves right. And when ego enters the market, account balance exits the market. Overconfidence also creates unrealistic expectations. A few good days make traders believe they can double their account every month or achieve 80% accuracy. They forget that markets are dynamic. Trends change, volatility changes, conditions change. What worked yesterday may not work tomorrow. But overconfident traders don't adapt. They stick to old habits because they believe they cannot be wrong. One of the biggest effects of overconfidence is the breakdown of proper planning. Instead of setting targets and stop loss, traders start entering positions based on gut feeling. But intuition without experience is simply guessing, and guessing has no place in trading. Every successful trader you admire today has gone through this phase. They've experienced ego, pride, and the illusion of control. But they learned, often through painful losses, that overconfidence is more dangerous than fear. Fear at times keeps you cautious. Overconfidence makes you careless. Think about your own trading journey. How many times have you lost money not because the market was unpredictable, but because you refused to accept the loss? How many times did you hold a losing trade because you believed it would come back? How many times did you increase your quantity just to recover faster? These are not technical mistakes. They are psychological traps. The market tests patience, discipline, and emotional stability. Overconfidence weakens all three. It pushes traders to break rules, ignore charts, skip analysis, and chase trades. And when the crash happens, it happens quickly. So what's the solution? First, accept that being wrong is part of trading. No one is right all the time. Even top traders have losing days, weeks, and sometimes months. They survive because they respect the market and respect their limitations. Second, always use risk management. No matter how confident you feel, never skip your stop loss, never oversize your trades, and never risk more than you can afford to lose. Third, treat every trade as a new trade. Forget previous wins and losses. Confidence comes from past success, but the market does not care about yesterday. Fourth, keep learning. The more you learn, the more you realize how much you don't know. And that awareness keeps you grounded. Finally, remember this every day. Confidence is good. Overconfidence is fatal. Confidence helps you trade with clarity. Overconfidence makes you trade with ego. Confidence builds discipline. Overconfidence destroys discipline. Confidence comes from skill. Overconfidence comes from illusion. So the next time you feel unstoppable after a couple of winning trades, take a moment. Pause. Look at the chart again with a calm mind and ask yourself, am I thinking logically or is my ego making decisions? That small question can save your entire trading career. That's all for today's video. If this message helped you, make sure to like and share it. Many traders are losing money not because of the market, but because of their mindset. Thank you for watching. Stay disciplined, stay humble, and trade safe.